Let's zoom out a bit and have a macro view about the recent bounce in Chinese technology stocks and whether this is just a one-time thing or if this rally actually has legs. So what we are looking at here is a performance comparison of the last 3 months between various indices as well as some single names and gold. So the yellow line here, this is kind of the benchmark which you almost didn't lose any money. It's only down 4.5% more or less over the last 3 months. Whereas if you had all of your money in QQQ, so that's the Nasdaq, then you would have lost 21%. Most of the US names by now have entered the bear market territory, and even more so the high growth technology stocks that are in the ARK portfolio down minus 41% only in the last 3 months. But where could you have actually gained some money? Well, if you would have invested in KWEB, which is the CraneShares China Internet Technology ETF, sometimes I have Brandon Ahern, who's managing this fund on the channel here. And basically, this strategy is up, well, just 1%, but at least where do you get positive returns right now? So over a period of 3 months, up 1%. Some individual names like JD.com are up even more. Some are slightly lower, like BIDU, minus 6%. And of course, if you look at a shorter period, just like 1 month, you can see the outperformance of the Chinese internet sector here. But obviously, this is due to the reason that those Chinese names have sold off extremely, and maybe it just have bottomed first. We don't know that yet. We can never call for a real bottom, but for sure we have some sort of consolidation and upwards momentum right now. And I think the reason for that can be found in the fundamentals. What did we hear about the technology crackdowns, the COVID lockdowns, and all of the things around Evergrande and the economic situation in China and how bad it is? And now actually the numbers are coming in, and they're coming in quite a bit better than what analysts have anticipated. So for example, BIDU beats on the bottom line as well as on the top line, so revenue growth as well as on the earnings per share. Similar results in the area of e-commerce, JD.com, Pinduoduo, as well as Alibaba. All of them have actually been beating estimates more or less. And so actually this begs the question whether or not this is kind of a healthy shift, and whether the Chinese consumer is in a better state that we actually anticipated. And I would say the media narrative out there is still not quite sure about that. Basically, you still get those negative headlines. For example, here, China's JD.com posts the slowest growth ever in this 618 important shopping holiday. So that's the one important shopping holiday besides the Double 11, which is in November. And that's, of course, a very important indicator. And well, while these headlines are quite actually negative, still, who would have thought that JD.com can actually grow their revenues year over year during this shopping holiday by 10%, despite what is going on with the lockdown situations in China. So while these numbers are admittedly not as strong as in the past, still those negative headlines are actually, not telling the whole picture. For example, I looked at some positive examples here. So the post-95, so people born after 95 generation, the pre-orders for them during this shopping festival were up 75% year over year. Very small rural cities in China also have seen an impressive 100% year over year sales growth, and home appliances up 200% year over year. Healthcare, of course, almost up 200% year over year as well. Similar on Pinduoduo, also home appliances are up 100% year over year. And so it seems that the Chinese consumer doesn't appear to be dead at all, but not as much in a buying mood than in the past. But now that the lockdowns have been lifted, and also we get all of the stimulus programs, consumption vouchers, as well as more lending, mostly on the business side, but also for mortgages. So the housing sector is showing some little signs of recovery. This is actually, I think, what this current rally is about, that now finally the stimulus can find its way. And while we are tightening in most of the Western countries in terms of the monetary and fiscal policy, in China the opposite is happening. And these are now the effects that are kind of, making investors interested in allocating more capital finally to China again. But I also want to show a little bit of a warning here particularly for Alibaba investors. So this is one of my close contacts from China. He's in Shanghai, an Alibaba Tmall partner, and he has good insights actually what's happening in the background. And that was posted 1 month ago. That reality check is that in many of these provinces actually orders couldn't be fulfilled from the backend. So the logistics bottlenecks have been actually quite severe. So all of these earnings and revenues beats that I've just shown are actually something in the past in Q1. So Q2 might be actually quite ugly for some of these companies. And for example, Alibaba also didn't give a forward guidance, right? So there is reason to be cautious about this current rally, while it could get even more fuel in case that we see inflation data coming down and the Nasdaq and the US stock indices are actually, well, time for a relief rally. If that were to happen, then of course this could additionally add some fuel also to those risk on assets that are Chinese equities. And so this could even go further. Otherwise, we could see some setbacks based on the Q2 earnings and those expectations towards it, and maybe even new lockdowns. However, the market should also be, anticipating this already. They should know that Q2 is going to be a disaster in many ways. For example, also for NIO, it's not going to be pretty. That's what I said in the earnings report as well. And so I'm not sure if the market is not actually willing to look beyond just one terrible quarter. Q1 didn't disappoint too much, and it's showing signs of a turnaround. So yeah, if you are underinvested or not invested in Chinese equities, maybe it's time to think about it, because it's, as shown in the charts, a way to actually participate in some sort of returns and growth right now. And in some aspects, it's giving you some diversification. But that's just my views here. It's not investment advice. As always, do your own due diligence. Thank you guys for watching, and see you in the next one.